This is Joel Block, and you're listening to the Passive Investor Show.
The views and opinions provided on this show are for informational purposes only and should not be misinterpreted as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, please go to passiveinvestorshow.com. Hey PI listeners, this is John Fortes. I'm making it a point to speak to as many investors as possible. My goal is to position myself to be a blessing to my network through conversation. How could one be a blessing through conversation? The easy answer is by listening. A simple conversation can open many opportunities and doors. I always ask myself this: what do I have to lose by having one more conversation? Going back to high school, I've connected friends and family in my network to one another, even if it didn't benefit me. And I continue those same principles and practices. Why? Because it's the right thing to do. If I can't help you, I probably know someone or something that can probably solve your problem. I'd love for you to become a part of that network. Go to www.johnfortes.com, create your investor profile, and schedule a call. How can I best serve you through conversation? In the words of Clarence the Angel from It's a Wonderful Life, no man is a failure who has friends.
And now, the Passive Investor Show. Here's your host, John Fortes.
Welcome, PI listeners, to the Passive Investor Show. I'm the Passive Investor Consultant, John Fortes, your host of the only ranked podcast for passive investors in multifamily syndications and real estate funds. Our goal and purpose of this show is to be a resource to investors and help them master their passive investments by beating inflation 1% at a time. Welcome back, everyone. Thank you for coming back to the show and listening. Today, I have a special guest. It is Joe Block. Joe is CEO of Bullseye Capital Fund, a real estate hedge fund that acquires distressed real estate assets nationwide, though he has also spent many years in the venture capital business. Joe has conceptualized, capitalized, operated, and sold several companies, one of which he sold to a Fortune 500 company. He has taught thousands of real estate brokers, CPAs, attorneys, and investors about capital raising and best practices for structuring group investments. Joe is a national recognized expert in private placements, Reg D offerings, operating agreements, deal structure, tax issues, and capital raising approaches with both accredited and non-accredited investors. He is regularly called on by attorneys and courts of law as an expert in matters of financing and real estate. Joe, welcome to the show and thank you for being here.
Hey, John, thanks. How are you?
Good, man. I want to unpack some of that because it really, really fits perfect with the show. So can you tell us your background and how you got into it first?
Well, as a youngster, I became a CPA, and I worked at Price Waterhouse years ago. Actually, Price Waterhouse Coopers now. At that time, it was not. And the last account I worked on there was a giant real estate syndicator. So it was a company that was putting together deals. And I worked on these windmill deals, where they were raising money to do windmills in the 80s, and then they were buying real estate. And my job was to do the tax returns, hundreds and hundreds of tax returns with many other guys, And I hated doing the tax work. I wasn't even very good at doing the tax work, but I loved reading the partnership agreements. And I said, I want to be a deal maker like these guys, not a tax return doer, but a deal maker. And I left the firm and that's what I did.
So did you just kind of dive in and do it on your own, or did you find someone to help lead you, or did you educate
in
yourself?
the 1980s, we were, I was a kid, I was young. So I didn't know any better, and I made a lot of mistakes, and I did a lot of things I would never, ever do, and I wouldn't allow other people to do either, by the way. But, I met another guy. He was a real estate guy, and I was kind of a money guy. And the two of us agreed we were going to put a deal together. So we found a deal, we tied it up, and we hired an attorney to put together some paperwork for us. It was very simple, a little mini private placement. And we went out and started cold calling doctors, basically, and got them to give us some money. and we got 22 doctors to give us $7,500 a piece. We probably broke every rule in the book. I mean, it was really but that's how you learn, right? That's how we learned. Luckily, nothing went wrong, and we got up and running that way. So that's how I got started in this business. I mean, it really was nothing fancy. Now, for other people, now years later, and probably 40 deals later, I teach other people how to do this and how to do it properly and how to be compliant with the law. And I've kind of learned the error of my ways as a youngster, and I've gotten better at this. And listen, and now I speak to courts of law about things that go wrong, and I look at deals and I help attorneys to structure their cases and so forth.
That's awesome. Thank you for sharing that. Now, do you still do one-off syndications, or do you just practice in funds?
I haven't done a syndication personally in a long time, because I like the idea of having committed funds, in a bucket. And basically, the difference between a fund and a syndication, just to be clear, because a lot of people, are not clear. And there's no legal definition of this. It's just the way that I think about it is that a syndication is a one-off project. It's a project. So you find an apartment building, you go and you raise the money for it. You do whatever you're going to do. You improve it, you lease it, you run it, collect the rents, whatever you're going to do. And at the end of the time, you sell it, you give the investors back the money and their profit, you wash your hands and you're done. That's it. It's over. And then you find another deal and you start over again and you go raise new money. And so this cycle starts over. With a fund is more of a business, and a fund is an ongoing structure. So when you you still buy the property like you did before, but when you sell the property, instead of giving the investors back their profit and their capital, you just give them their profit, you hold the capital back, and then you go find something else to buy. So, in a fund structure, the investors have to trust you more because you're going to have a lot of discretion. In a syndication environment, they may say, hey, listen, I'd like to see the property you're going to buy. Not that, that there's any really great reason for them to do that. I mean, when the doctor says you've got some problem, I don't think you go in and investigate the situation before you let the doctor work on it. But that's just how it is. So people kind of like to look sometimes at the syndication deal in a fund. The investors are basically giving you discretion.
No, I like the fact that you just kind of broke that down. And also the fund allows for more diversification than a syndication, right?
Well, and here's where that really applies is that let's say you have 20 buildings in a fund or 10 buildings in a fund, and you've got one building in a syndication, you got one property, and you get a bunch of vacancies for some reason. Whatever the reason, could be many different reasons. There could be an uninsured loss. I mean, it could just be an economic calamity like we're dealing with now. When you've got multiple buildings, no single vacancy or two or three is going to really do a lot of damage. And so a lot of people like the diversification of a fund, but that's, listen, different strokes for different folks. They can go into whatever they want. What also happens, by the way, these structures are not mutually exclusive. What happens sometimes is that you may have a fund and a couple of investors may call you and say, listen, we'd like to do a side deal. Can we do something separate? Okay. The syndicator may find a property that's not suitable for the fund. Now, suitable doesn't mean that it's a bad deal, and it doesn't mean that it's a great deal that belongs in the fund. Let's say the fund is a residential multifamily deal. Well, if you find a car wash for sale, that wouldn't be suitable for the fund. But that doesn't mean that you shouldn't buy it either. You just probably shouldn't buy it with the fund's money. So what you might do is talk to two or three investors and say, listen, I just found this smoking hot deal. It's a car wash, or it's a movie theater, or it's a mall, or whatever commercial property. It's not suitable for the fund, but I think that there's something to be done here. Would you like to get involved? And, you can invite all the investors. You can invite a couple of the investors. You can do whatever you want. So one of the things that investors have to know is that the documents usually do not restrict the syndicator or the fund manager from working on other deals. And they can work on whatever deals. And by the way, the investors can invest in whatever deals they want, and the syndicator can invest in whatever deals they want. Now what I tell syndicators is you can't give all the cruddy deals to the investors and keep the really good ones for yourself. I mean, that because that's not a business. they'll be out of business in 5 minutes. But once in a while, it's going to happen that they're going to find some deal that just doesn't work for the fund or whatever the structure is. And they're going to want to do something on the side.
Oh, I love that you broke that down and show us the nuances and the flexibility of it. Now, what kind of real estate assets are you producing? I mean, are you purchasing with
Well,
these
our
funds?
fund has reached the end of its useful life, so we're winding down. And we, because we had kind of promised the investors 5 or 6 years, and we're at about 7, so we're unwinding everything now. But we were doing residential properties, and we ended up buying.
Real quick on that. Is it because you had built-in extensions on that fund from 5 or 6 to allow you to get to 7?
5 doesn't necessarily mean 5. I mean, you do your best. You say, listen, it'll be about 5. It's never 5 because, if you don't have the property sold, if you're not cashed out, if the market's not right when it's time for you to liquidate, then it may just take a little longer or whatever. So, you have to understand that 5 is a goal. It's not a commitment. And so, we said 5 or 6 is a goal. It's taken a little bit longer because of the nature of the assets. We had some distressed notes that are taking a little longer to liquidate. And that's normal. I mean, it's not really out of the question that wouldn't be something that happens.
Awesome. Now, when you're structuring these funds, how are you structuring them? Is it a 2 and 20 similar to a hedge fund? Are you
No,
go ahead.
stock funds are set up as 110 or 220s. I mean, that's and let's explain what that means. I mean, maybe people already know, but a stock fund, basically the fund manager takes a fee, and that fee is 1% of assets and 10% of profits, or it could be 2% of assets and 20% of profits. By the way, it could also be 2 and 10, 2 and 5, 2 and 3. I mean, the numbers are whatever you guys agree on, whatever the fund manager picks. So it's kind of a standard that it's 1 and 10 or 2 and 20, but it doesn't have to be like that.
What's your standard?
We don't do it that way because in a real estate deal, those are stock deals. Those are stock market deals. In a real estate deal, the deal needs the manager in a different way than in a stock deal. So in a real estate deal, it's common that the syndicator or the fund manager will also be the real estate broker, and they'll be the property manager, and they'll bring a lot of other vendor services to the table, which are perfectly legal to bring as long as they're properly disclosed. And I'm not an attorney, by the way. I'm just telling you what I know. I'm a CPA, as I said. But as long as these things are properly disclosed, they're perfectly fine, and this is the way it works. So typically speaking, the investors don't mind the real estate way. They don't tend to like the stock way. And here's why. Is in a real estate deal, there needs to be a real estate broker. So might as well be the syndicator. It doesn't really cost the deal extra to have the syndicator be the broker because somebody's going to be the broker. It doesn't cost extra for them to have the syndicator be the property manager because somebody's going to be the property manager anyway. Might as well be the syndicator because it's not in anyone's interest for the syndicator to run out of money or have to go get a side job to be able to, because he's waiting for money to come from the deal. So the syndicator has to get some money from the company or that person isn't able to keep going. When you take a percentage of assets, that's not the same as being the real estate broker, which is necessary, and you're going to pay somebody anyway, because an asset fee, you wouldn't be paying anyone if it weren't for the fact that that syndicator plugged themselves into that situation. So really, the asset management fee is an overhead fee. And on the stock market, a lot of the institutions, the pension plans and the retirement funds, they don't like paying those fees because it's an indirect type of an overhead expense. So it's really different. So most real estate funds, most real estate, oil and gas, movies and other kind of things are done not on the asset management fee basis, but on the basis of performance and rendering of services. Now, the back end fee, by the way, which is called the carried interest, that fee, is in real estate, ours is 40% because we're producing an enormous, if it weren't for the syndicator, there wouldn't be any profit at all. So in a development deal, it might be 50%, 50-50. If you're buying a AAA apartment building where the syndicators aren't really doing anything, maybe the syndicator gets 5 or 10% because they're just keeping track of the building, but they're not doing a lot of work. So each deal is different.
So is it safe to say that it's more of a split of the operating cash flow on an ongoing basis?
It's cash flow and
the carried
profits.
interest.
So
Yeah.
profits from sale. So there's fees and there's profits, and the syndicator will get paid fees for doing services and a percentage of cash flow and profits from operating activities.
Have you ever encountered a fund where someone couldn't include fees on their fund?
Couldn't, because why?
No RIA exempt form completed?
Well, keep in mind that in the real estate world, most all of us are operating under the exemptions anyway. So we're not licensed people. So we're not raising capital. We're not brokers of anything. You know, you can sell your own house. You don't have to have a license to sell your own house, but you cannot get a commission for selling my house because you're not licensed, or maybe you are, I don't know. But that's the same thing in securities. You don't need to be licensed to sell your own securities. So if I start a fund, an LLC, and sell securities and then raise money that way, I don't need a license because I'm exempt as an officer of the company. But if I want to broker your securities, I need to be licensed. So most of us are just selling our own securities. We're not brokering money for other people, and we don't need a license. So I've never run into a situation like that because I deliberately counsel people to avoid that situation and keep them out of those situations.
Thank you for that. What is something that early on in your business, when you were going with this fund process, that you had to incorporate to become fully operational instead of look like a small business startup process?
Probably setting up a team of people to operate the company and to do the many things that needed to happen. You know, there are a lot of moving parts in a fund, in a syndication too, by the way, but especially in a fund. You have, and you got to divide it. Really, there's 4 different things that are happening. Somebody on the team has to have exceptional market skills. In other words, what's the real estate or the whatever asset you're working in? What's the market going on for that? Somebody has to have really good capital skills, and they have to understand how the money works. Somebody has to have really good asset management or property management skills, because if you buy a building with the goal of turning it around, somebody has to be the turnaround person. They have to do that. And finally, somebody has to have really good vendor management skills, the CPA, understand, work with the accountants, the attorneys, the investors, because those business management skills are going to be necessary. And there's a lot of business management to do. So it's possible that one person could do all those things, but not typically.
What is the difference between the way your first fund looked to how it is now?
Well, I've only had one fund. I mean, I've had many syndications, and the last one for the last 7 or 8 years has been a fund. So that's a significant difference. And
so it is sorry to cut you off. Is it a rolling fund where you can bring people in?
No,
or no?
Really, most funds are probably what you would call rolling. But in order to do that, you have to open a new round. You can only raise money when certain windows are open. And this is to prevent fraud, like prevent a Bernie Madoff situation. Bernie Madoff's window was always open, so people could always put in money. And because they could always put in money, he could always keep that Ponzi scheme going. The way that most things are done, the way that we encourage people to do things, is that these raises are bounded by either time or amount. So if somebody says we want to raise $5 million, they may be given 6 months or a year to do it. So that round or that set of documents is going to expire the sooner of when the 5 million is raised or when the clock strikes 1 year or whatever the number is. And so if you've raised $3 million and it strikes a year, the round's over. Now you can go do another round if you want to. And the operating agreement usually gives you guidelines about how that works. Do you have to offer the other investors first? How does it work and whatever? So, you just have to follow the rules that you set up. And that's why it's so very important to set the rules up in a good way.
As a passive investor, what is the best advice you can give when you're analyzing a fund as aside from comparing it to investing your capital in a syndication?
Well, let's talk about two different things. Let's talk about what kinds of things investors should be looking at in the first place. And then we'll talk about whether it's a syndication or a fund, because the first one is kind of more important. There are certain types of things that syndicators can build into their deal that are more investor friendly than others. And you want to make sure that the deal is somewhat investor friendly. Now, it's not going to be perfect because the documents are really designed to protect the promoter, the syndicator, from the investors suing him or giving him all kinds of grief over different things. But here's the first thing. I've had lots of investors over the years that have called and said, Joel, we were driving by the property, my wife and I, and it's Christmas time, and we think that you should plant red flowers in front of the building because it would look very nice during the holidays. And I will very politely say, thanks for your input. Don't ever call my office with anything like that again. Now, why? It's not because I'm rude. It's because what I'll say to the person is, look, I appreciate your input, but if you want to act like a general partner and be liable like a general partner, then come take a desk in my office. But if you want to retain the limited liability status that you're afforded under the law, then you can't talk to me about operations and how to run the property. And in every case, they always say, gee, we didn't realize that was the case. So number one, you want to stay out of the business. But number two, things are investor friendly. Let's say that you're doing some estate planning as an investor and you want to transfer your shares to your grandchildren. You shouldn't have to get permission from the syndicator to transfer your shares to your grandchildren in in an estate planning discussion. Now, if you want to sell your shares to your next door neighbor, we don't allow that. Why? It's not that we're not friendly. It's because we don't want some cantankerous, rude, agitated person to come into our deal and wreck up the mix. We pretty carefully handpick people that we want to be a part of our team. We try to get along with people. We become friendly with people. And we want to screen them. So we don't want people moving their shares around. And by the way, we have the absolute right to determine who does that because we have an exemption to protect. And so we have to be very careful about moving shares around. But there's certain types of things that are investor friendly. And you want to make sure that those things are built in for you. Now, the difference between a syndication and a fund, there's not as much difference as you think. I mean, really, what's the criteria that they're going to use for buying new properties? How's it going to work? If something happens to the one syndicator, is there a second person to take over? Either a successor? Does the person have a partner? Those are things that people need to be concerned about.
How are you going about and finding investors these days? Are you working with more RIA firms? Are you working with more family offices? Or are you working still with private investors or all of the above?
Private investors. I personally just prefer to deal with individual people who own their own money. The problem with a family office, from a syndicator's point of view, is that you're dealing with a gatekeeper, a CPA or an attorney or an investment advisor who doesn't own the money. If you deal with an institution on Wall Street, they don't own the money. I like to deal with Dr. Smith, who owns the money. It's Dr. Smith's money. Dr. Smith can do what he wants. If he or she wants to say yes or no, they do what they want, and that's it. So I like to deal with people personally. We don't deal through brokers. We don't deal through RIAs. We don't deal through any kind of intermediaries. We just like to deal with folks who own the money, and over a long time, we've created a lot of relationships.
How are you finding those leads now, or how are these investors finding you these days?
I've got a pretty big platform. I speak often, of course, not this year, but I mean, I speak to organizations, not related to the fund type stuff, but I talk about disruption and business issues, and I speak in corporations. And I may mention that I run a fund and whatever. I don't talk about it, but I may mention it. And it always happens that somebody will come over and privately say, can I learn more about your fund? I'd like to maybe get involved in something like that. And if they want to talk about it, then we talk about it. We talk about it offline. But that's kind of how it works.
Awesome. And I meant to ask this earlier. Do you offer a pref with your funds or no?
Yes.
That's awesome. Is
Yes.
it usually 6 to 8 in that range?
I think that 8 is a really good number. Smaller investors, smaller operators like I am, people that kind of operate under $50 million, there's a little more risk. So you need to provide a little bit more juice for the risk. And I tend to think that 8 is a fair number.
Now, because of diversification, could you be able to provide a 6 pref, a lower pref, because you're providing more
listen,
diversification?
you can, but here's what happens. When you start getting, towards 6, investors have other alternatives that are a little safer. Their stockbroker can offer them something for 5 or 6, maybe bond yields, or maybe there's some other things they could do. Now they're not getting exposure to real estate necessarily through those types of deals, but they start to have a similar return. And we need to kind of be in a little bit of a different bucket. And so you got to kind of jump the price just a little bit to make that happen.
Got it. I love having the pref conversation, so don't mind me.
No, it's all right.
I appreciate you. Joe, how could we stay in touch with you?
You can go to my website, bullseyecap.com. My contact information is all there. And I'm happy to, be in touch.
Now, I know that you also teach people how to create funds and stuff. Can you speak a little bit on that? I want to give you that opportunity.
Twice a year, and until this year. And this year we just did it one time. People that are doing real estate deals, we probably are the preeminent trainers of these real estate investors. A lot of the guys who have TV shows, they never talk about where the money comes from, but the money is the most expensive part of the whole deal. And they never talk about it. Everybody talks about fixing the swimming pool is the expensive part. It's not, it's the money. The money tends to be the most expensive part. So what happens is that a lot of these guys are doing, one deal. Maybe they'll have one house going at a time, or 2 houses at the most. And they like to do 5 or 10 so that they could keep their crews busy, but they don't know how to organize the money. We help them organize the money. We show them how it works. And we've probably, our training has probably spawned 100 funds and 125 syndications. So we've, and people have probably raised close to $1 billion that have gone through our program.
I have one question before we close the show. Are you more inclined to do a 506C or a 506B? Which way do you?
Here's the thing. B. I like the B offerings because people who do a C offering do not always get the results they expect. They think that C is going to be a shortcut because now they can advertise. But the truth is, very few people know how to do internet advertising, and very few people, and it's much more expensive than they realize, and they don't end up getting the result that they think.
Good point on the internet advertising. Good point on that. I appreciate you. And my favorite question before we go is, what is the meaning behind your company name?
I'm always about bullseye. You got to hit the bullseye. You got to hit straight on. And, I'm about bullseye, and I talk to corporations about, getting their people aiming at a bullseye so that they're all marching in the same direction. I call that an organizational bullseye. And so, I've just always kind of been about bullseye.
And don't forget your book too, right? You have a book.
Stop Hustling Gigs. It's a book that's for entrepreneurial people. I'm actually working on a book about disruption as we speak. But the book Stop Hustling Gigs, I spent a lot of years in the venture capital business, and I just aggregated a lot of the ideas that I got from that business, really so my kids could understand how I think. But it was too good not to share.
For the kids.
It was too good.
I love that you shared that. Because I started this for my kids to be able to know that, when I'm gone one day, they have something that I was really into.
That's what my book started out as. But when we looked at it, when it was pretty much done, it was just too good not to share.
I love that. Thank you, Joe. Thank you for coming on. Thank you for stopping on the show. We really enjoyed the conversation.
Happy to be
Appreciate you.
here.
Don't forget to download your free copy of the investment tracker. It allows you to track up to 5 investments, compare sponsors, markets, and most importantly, projected versus actual returns. To get your copy, go to www.projectedreturns.com. PI listeners, thank you for listening. As always, we hope this was the best resource for your investment strategy, but also the best use of your time. Remember, if this episode helps you, you can help us by leaving a review on iTunes. I hope you feel compelled enough to share it with someone you think this would resonate with as well. As much as it pains us to leave you, but you know what time it is. Time to go put this into practice. Till the next time we meet, happy investing. PI listeners, I'm grateful for your time and I appreciate you for listening. It would mean the world to me if you went to iTunes and left a rating and written review. Let me know how you feel about the show. It really makes a big difference with getting the podcast out there. Don't forget about our Facebook group, where all of our guests are members of. I'll be there to answer any of your questions, or even questions you might have for future guests. Subscribe so you can get the latest episodes and our fan favorite quick hitters. Finally, I want to keep you updated, so head over to johnfortes.com and sign up for the newsletter. If you're interested in partnering with me, sign up on the contact page so you can talk to me directly. I look forward to connecting with you. Happy investing.